Hello, everybody. Kirk Spano, and welcome to Retirement Income Options on Monday, November 20th. Just a few days between now and Turkey Day, and Kirk making his chumpkin cake pie. We talked about that the other day. Won't get into it, but I am fasting today, tomorrow, and Wednesday because I had a birthday party yesterday for the grandkids, which was a lot of fun. 2 and 4-year-olds do not need a bowling birthday party, but the adults had fun. The kids stuffed themselves with pizza and cupcakes and cake, and they got little gift bags that my buddy brought something over for, little Scooby Doo puppet wallet things. If you haven't shopped for cell phones lately, make sure you do that, especially if you can get a business plan, because Verizon, which I never imagined it would be Verizon is cutting my cell phone expenses by about $1,000 a year, which is, a lot because I spend too much on cell phones. Verizon of all companies is the one that's given me the deal, and knock those phone lines down to $25 a month by bringing my own devices, which I have too many phones, and then getting rid of the plan price that I still have with AT&T. So I'm going to actually go to AT&T this afternoon, see if I'm missing something, because as we know, Stocks of the Week, which will be out tonight. Oh, by the way, Stocks of the Week will feature my current holdings with whether or not they are starter, half size, or full size positions, and in a couple of cases, double size positions, or in one case, triple size position. The reason I didn't want to get rid of AT&T is because AST Space Mobile moved their launch of their next 5 satellites up. So in the first quarter, AST Space Mobile will launch their 5 satellites. They changed where the satellites will be positioned and where they'll point, and it's designed so that AT&T can have full North American coverage using the satellite as the backup to their cell tower networks. And I think that's very interesting. So if you still own AT&T, I would not be writing any covered calls on that because I think you might get a pop sometime next year. I still don't love the stock. I still don't think they're going to be increasing their dividend. I do think they get around the buying back shares sporadically a few years out, but then they're going to run into new capex for 6G, and they're never really going to get a hold between the 5G and the 6G capex expenses and the fiber expenses, and they still have a ton of debt. It's just going to be a slow grind for AT&T forever, and I think they'll be buying back shares as a way of offsetting the fact that there's just not a lot of investor interest at really any level, and the fact that they can't really afford to add to the dividend. I mean, they can buy back shares because that extinguishes some of the dividend that they pay out. So I'm not in love with AT&T. I know some people like to look, oh, maybe they'll come back. And I thought so for a long time. But then when I realized that the 6G was just going to run into the 5G and the fiber expenses and how expensive it is, I just can't put it in my top 30 dividend stocks anymore. But if you own it, I would avoid the covered calls until it gets a rally, and then you can write covered calls because any rally that it has probably isn't very long rally. All right. What else do we got? So I hope that you've enjoyed the Investing 2020s channel. It's been simplified, been getting the posts up pretty quick. Investing with cognitive dissonance, I think, is something that everybody needs to watch. The process, paradigm, and investing in Ametas, just kind of an outline of what the article will eventually be, and that I have sent out already to some hedge funds and other places. So that's why it's not published, because I have to give them exclusivity to the research. So I'm just telling you, I still like Ametas. Let's see, we did the major markets weekend update. So I think that's a real good macro look at the market. And then we'll have another retirement income options up later today. The November expirations update. So I had some puts put to me. I got Sun Power on Friday, and I got some Enovix on Friday, and the Enovix was like perfect. So they were $12 puts that I got like $2.50 for. So my net cost was $9.50, and the stock's $11 right now. So that's a pretty good deal. if I wanted to turn around and just write covered calls on the NVX, I could. I'm not going to because I think they have a big contract announcement coming. But at some point, I might, because I'm not a believer that battery technology stays ahead for very long. Although I do think they get some contracts that make them certainly one of the big companies in the industry, and their market cap can go up because of that. So I still think NVX is $30 to $50 stock in the next several years. I don't want that one getting called away on me either, because, as you know, we need to let our winners run. All right, what else? Paramount, interesting news. Sherry Redstone and the CEO put in place a change of control bonus. And she did say that she is willing to sell the company at the right price. I'm just saying, not saying, just saying, it just makes a lot of sense that Apple would buy Paramount. Just makes so much sense to me that they would do that. Apple would get CBS, they'd get a library, they'd get studios, they'd get stars, they'd get sports, they'd get so much stuff. And, Apple sits on a mountain of cash. You got to do something with it. So if they gave Sherry Redstone a combination of shares and cash, Apple shares and cash, I think that she'd be willing to do that. And I just wonder what the price would be. I do think that price is pushing $30 per share. Right now it's at $13.50. I think that you can sell cash secured puts. I think that you can sell the $15 cash secured puts. So let's take a look at how that looks. Go over to Option Strat, and we put in PARA, Paramount Global. Give it a clicky and say March. I'm going to go to March. Could do January. Let's take a look at January. January puts, $15. You're getting $1.50 a share, so $150 a contract. I know other people like to look at it this way. That's not how I was taught. I always looked at it the per share price, but you can look at it anyway. The reason I look at it as the per share price is because it helps me in my head say, okay, this is what my net cost would be. So right now, the stock is trading at $14.19. You get $1.50 for the $15 January put, which means your net cost would be $13.50, way below the $14.19. And I really don't think it's going to get put to you. So you just get to keep that cash by writing something in the money. You're getting the extra cash. How much more could you get if you wrote March? You get almost $2, so an extra 50 cents. Now, if this expires in January, probably you would turn around and write the June for another $1.50, but at a higher strike price. So if you're really just looking for cash from this transaction, you want the most premium that you can get, I would sell the March. And then what I think will happen is that by January, the stock is higher, and you're probably able to buy this back for way under the difference between these two puts. And then you can turn around and write a June. So I would be writing the March $15 puts, getting about $2, right? Gives me a net price of $13.01, it says here. I don't think that's going to come back to you. If it does, great. I did buy some Paramount this morning that made up for what I sold for the tax loss when it was over 15. So a pretty good trade. I got the tax loss on the sale at 15, 16, 17, whatever I sold it for. And then I got to buy it back at a lower price, and I get to keep the tax loss. That's why you do your tax loss selling right after Labor Day, September, October, because a lot of times you want to buy this stuff back way in advance of the end of the year. Institutions generally do their tax loss selling in October and November. So that's why I do September and October to get ahead of them. Too late on this one. You should be buying Paramount and selling the cash secured puts. All right. Who else? Warner Brothers Discovery, same boat. They're for sale. They're able, by law, by tax rule, to be sold in April. Why is that? Because when they did the merger with Discovery, that put in place some restrictions on them changing control again. April is when they're allowed to change control again. So let's take a look at Warner Brothers Discovery. Yeah, 1070. I'd be going in the money on this one too to get a much bigger payout. and not worry about trying to get cheaper price if it's put to you, because it's pretty cheap. So it's 1070 right now. You can get almost $2 on the 1250, which means your net cost would be, not much different than this. I think that's the one you can sell, the January 1250, or go to April. Let's see how that one looks. January 1250, 228. Not a lot more. It's not as big of a difference as the Paramount. So I would probably sell the January 1250, because we are, as we discussed the other day, coming up on what looks like it's going to be a pretty good Santa Claus rally and January effect. And that's why I've been doing some longer term cash secured puts to try to capture some extra premium. If you go back to the older retirement income options, and usually you want to look at the last 2 or 3 weeks, Ford is still a great one. When you put Ford into your handy dandy option strat, I do think if you're an option seller, this is a great site. I'll send you the link again. Ford, here you go, February. So if you sell the $10 Ford puts, you get, almost 50 cents for that. If you put in the order at 50 cents, it probably gets hit on the volatility. That's a pretty good return, 5% for 3 months. And it's a stock that you want. This is one of the stocks that I have a full position in. I think that Ford, because of the dividend, and because I think that there's ultimately a shift in sentiment from a lot of people who have been investing in Tesla over to Ford, where they might split their investment between Tesla and Ford. I don't know if they leave their Tesla investment completely until, of course, maybe Tesla lags, and then they'd really pile in the Ford. So I think you have maybe 3 waves up of Ford coming. That is kind of what the charts are showing. And I do think that Ford can actually be a 5 to 10 bagger here in the next few years. I'd say 5 years at the outside, but I think there's a good chance for in the next year and a half or 2 years that you just see a mega rally in Ford as they make announcements that the market likes, as they progress, as they beat their numbers because they don't set the bar too high, as they get into other businesses that nobody expects them to do, as they sell off a piece of real estate here and there that really improves their balance sheet. So I really have a hard time thinking that there's really going to be any problems with softening EV demand, because the truth is that just is a function of financing at this point. The actual demand for EVs is going to show a huge pent-up demand from people who are just waiting to get a better deal. People like me who have the money to buy an EV are like, in the next 2 or 3 years, the tax credits will still be there, the batteries will be better, the cars will be cheaper, and they'll have worked out more of the kinks. So the pent-up demand for EVs is massive and building, and everything is on track for 2026 and 2027 to show an incredibly huge inflection point in EV sales. There's really nothing that can stop it. The capital has been deployed from the corporations themselves. Big money investors are soaking up shares of Ford and GM. I would be shocked if Berkshire Hathaway doesn't buy back GM and Ford at some point. Might not be a Warren Buffett decision, but he's not going to be around much longer. Let's just face the facts. So the new investors there are way more likely, and they have been doing it more. The position trading that I suggest that you do, where your intention is to own things for several years, not forever, because what you're trying to do is catch something when it's undervalued, has stopped with its downside momentum, is starting to build a big base, and is likely to break out in multiple waves. And when that happens, you make a ton of money. And you can sell some covered calls on the little mini corrections and pull in some income. Ford is going to be one of those. It's probably going to head to its resistance levels up above, somewhere at 18, 19, 20 pretty soon. And then it'll have a breather, and then it'll take off. And then eventually it'll have another breather, and then it'll take off. And it'll take off on that last wave when the FOMO hits, right? When everybody's like, oh, look, Ford is up 400 or 500%. I should buy it now. And we're like, yeah, why don't you do that as we just wait for that rising momentum to end, right? Before it really plunges on lots of selling. Wait for the upward momentum to end. Ride your winning horse until he gets to the finish line and he starts to slow down. So I think that you should be selling cash secured puts, and I think you should have a full position in Ford. I have a full position in Ford, and I'm still selling cash secured puts with the idea that if I end up with a double position in Ford, I am A-OK with that. Now, in big enough accounts, you could probably add GM, but I think Ford is best of breed. I think Ford has the culture and leadership to be better than GM. I just think they're a hair better, and I don't really need to have them both to get exposure to what I want exposure to. Plus, I think Ford has more upside. I think it's a better brand. Block has really run for us. It's up around, what, $60 a share? Had you sold this, you'd already be able to take a profit. And now if you want to sell puts on Square, pretty much have to go to 60. Now, you could probably write the 55s. You're still getting a pretty good piece of money. It's almost a 5% yield for 3 months. I really like Square. I think it's probably closing in on, that general 30 or 50% discount to fair value. I think fair value is 80, 90, 100 right in there. So you're still getting it cheap, not as cheap as it was recently, but it's something you probably should own. I have a half position in it with puts sold for another half position, but I think those puts are going to expire without the stock being put to me again. So I have to figure out, do I want to sell more puts or do I want to just buy the stock? I think the stock's going to make a run at 100 probably next year with the halving in Bitcoin and the fact that their balance sheet is going to show a lot of cash as they have already written off the Bitcoin as a loss, and then suddenly it's going to be back. Plus, we're not going to get a recession, folks. Growth is going to slow down, but it's not going to be a recession. And Block Square is really good with the small businesses as we go through over and over and over again. What other ideas were there? We can always take a look at Ametas. Here's a stock that, remember, they need to keep executing and they need to keep improving their financing arrangements, which I think that they can, because they have investment tax credits that they can use as the bait. Right now, if you sold the January $5 put, you'd be getting almost $1 for it, 90 plus cents. If you like the long-term story and you need more weighting to this stock because you're willing to take that risk of a micro cap turning into a small cap and the triple or quadruple that would entail, or quintuple, then go ahead and sell these puts. Now, you could go out to April and capture about 50% more premium. I think that that's a pretty good idea too. Ultimately, again, you have to assess your risk here, but I think that what's going to happen with Ametas in the next month, I would hope, is that they're going to improve the financing on the preferred extinguishment. Right now, it's a little bit expensive. It's cheaper than it was going to be by about 8% per year. But I think they can knock the interest rate down another 4-ish%, which on that amount of money would be $4 or $5 million if they don't have to pay out. If they could avoid the closing fee of $5.5 million, now all of a sudden they've saved about $10 million, and they validate the business model with a big new lender, right? Somebody comes and says, yeah, you guys are the real deal. We'll give you the $100 million to extinguish the preferred debt. Basically, same conditions at a lower interest rate. I think that that's going to happen. I know that they're talking. We'll see if financing has loosened up enough for that to be the case. You have a question. Somebody says most ETFs are outside the buying range. You recommend to fully invest soon. What is the best way to build positions in ETFs? Well, is go to Global Trends ETF report, whether you're at fundamental trends or margin of safety investing, and basically just follow along here. If you take a look at the asset allocation for the 401k plan, that is a pretty good guide, right? You see what I did. Just build along with that. Now, a lot of people don't want to use sector funds. What they'd rather do is just buy market cap funds, and that's fine. You can do that. You've got the market cap funds in there. If you want to overweight a sector, if you want to move a little bit of extra money into Asia, like I just did, you can do that. You have to decide what is the most sense for you. And one of the things in your thinking that you have to get away from is that I should own a little bit of everything. No, it's not true. You should not own a little bit of everything. Then you're just an indexer. you should own the things that make sense for you, that are really, truly in line with your risk tolerance. Because a lot of people say that they can tolerate the risk and the volatility, in particular the volatility of a sector fund. But then when it has a 30% correction and they don't sell it in stop loss style after 5 or 10 or 12%, they ride it all the way down and then they sell it. Oh, I should take the tax loss. Well, no. Either you have a trailing stop or you don't. I typically don't. I just look at it week to week, then I decide. So I think that you can add some Asia exposure. I think that's pretty smart. I think you can add some emerging markets exposure. I think that's pretty smart. Because what do we know that we talked about in the major markets report on Saturday, right? What did we talk about here? Not only do you want to buy any pullbacks, but in particular with the dollar looking like it's pretty much peaked out for a while and is likely to drift down for the next year or two, no crash. There's not going to be a dollar crash. It's just not going to be as high as it was, which was really high. And as dollar comes back from 110 or 12 or whatever it got up to, and into the 90s and maybe even into the 80s, that's really, really good for emerging markets and small caps. It's really good. So all the things I've been trying to prepare you for the last couple of years are happening. They've all been happening. I think the bear market has had some funny gyrations in 2023. I think it really has been upside down. It did the opposite of what it should have done, but then at the end of the day, it did both, so it didn't matter. And here we are looking at the potential big Santa Claus rally and January effect going into a bank hiccup sometime next year that's going to enable the Federal Reserve to lower rates and do QE over here while they're doing QT over there, essentially offsetting. And as we saw after they did the exact same thing last spring, you got a 2 or 3 month rally. I really like this stock market for the next 5 years when it comes to emerging markets and small caps and growth stocks. And I think some of the REITs are finally in shape to get bought or will be by spring. And that's why you sell puts, because if those strike prices are in the range of where you'd be interested in buying, why wouldn't you want to collect the premium for essentially setting a limit order to buy? And the reason why I think you can utilize all your cash right now, either buying stocks and ETFs or selling puts, and I'd rather just sell a ton of puts, because if the market is wavy for a while, general trend up, but wavy, right? Up and then a pullback, up and then a pullback, and then way up. With a little bit of management, you can buy back the puts when they get cheap, right? You sell them for an expensive price now. In a month or two, you buy them after a rally, and you capture 80, 90% of what you sold them for. Maybe you sell a couple covered calls at that point. Then the market gyrates down. That's why we generally sell puts and calls with 2 or 3 month durations. We know, statistically speaking, that most tactical moves in the market are 3 to 6 months. It's not something that most people want to trade. But if you're selling puts and calls using our cycle, you're probably going to do pretty well because you're always collecting premium. You don't have to be perfect. If something gets put to you, you decide what to do about it, whether that's hold it till the next time it rises or sell covered calls or sell it outright based on whether or not your asset allocation is okay. And you allow some wiggle in there because, again, you don't have to be perfect. You just have to be really excellent, right? Just keep coming back to that Vince Lombardi stuff. All right, so I am going to finish up the retirement income options expiration update this afternoon and tonight. I am also going to post my stock holdings and the position size. It won't be in percentages. It'll be whether it's a starter, a half position, a full position, or double position. And in the case of Ametas, triple position. And then you can go and look at the article that tells you about what percentages that falls into. So I want you to think about things from the standpoint of, okay, I've bought a couple of starters and now I'm going to buy another piece that gives me a half position. I'm going to buy another piece that gives me a full position, and how that correlates to the sizing of what you buy and the puts that you sell. So with the Ametas or Occidental Petroleum, let's take a look at Occidental Petroleum. If you have a big enough account, right, you need a 6-figure account to do this one. What did we talk about? What was it, 2 weeks ago? Right, we talked about selling Occidental puts in the chat room, right? buying some Occidental. I was selling puts at the same time. But basically, with Occidental, every time that the stock price gets around 60, I tell you, go ahead and sell some puts. And that's what happened last week. So right now, you could have sold the April $60 puts and gotten almost 5%. Last week, these were a little bit higher. And why do we do that with Occidental? One, it's a proxy for that whole industry. I think it's the best one among the big companies, and it has the floor under it from Berkshire Hathaway's interest. So, if you really want more of this, if you don't have it, go ahead and do it. But what I've been doing is I haven't bought really any Occidental until recently. It's all been put to me, but the vast majority of my shares that would have been coming to me because of the puts, they just kept expiring. I'd have to take a look, but I think I've gotten premium from Occidental 6 times the last couple of years, and only once it's been put to me. If I'm right about oil, I mean, really, the disruption of COVID and some geopolitical stuff is the only things that have changed timelines on me, because the story I've been telling since 2012 has been the right story. We are on the peak oil plateau where demand really doesn't go up anymore, but they are controlling supply to keep the price of oil plus or minus $20 around 80. If oil gets up to close to 100, they'll pump more. If oil gets down close to 60, they'll pump less. Saudi Arabia wants the price of oil around 80. Therefore, the price of oil is going to always get pulled towards 80. It's just the way it is. Can't be changed. The United States doesn't have the ability to ramp up its production any faster than it already has. We're at a record output right now, and they're trying to figure out ways to keep it there that's economic. And then, by the way, you've got the federal government that wants to buy a little bit more for the Strategic Petroleum Reserve whenever it can. This is a market that's roughly in equilibrium, an equilibrium price for now until demand starts to fall later in the decade is around 80. And even when demand starts to fall, maybe it'll still be around 80. Depends on what Saudi Arabia wants at that point. But I think that Occidental is the easiest big oil company to own because of the floor that Berkshire puts under it. Let's take a look at the Q&A, see if I answered them both. I did. All right. I'll get these articles out later on today. I do have a little bit of telephone shopping. I have to put my plans together. All right. Take care.